Hey guys, Max Convexity here. Thank you for tuning into my channel. I have a quick one tonight. Let's look at stock index futures. Let's look at some profit boxes and maybe answer a question or two. Let's start with stock index futures, and they just cannot be any flatter. NASDAQ is down a nickel, 5/100ths of a point, 5 basis points, nothing. ES is down 3/100ths of a basis point. So that's just about as flat as you could be. Then Russell is up 4/100ths of a basis point. So even altogether, they are super flat. Of course, I'll be back in the morning and we'll see where they've changed by then. I try to come on about 8 before the market opens, and sometimes they've moved by then. But let's look at this question I got. I had a nice question here from John Davis, 2584. John said, Max, love your content. I'm guessing that you're a big fan of the funds you are tracking. If you had to pick just one, would you be able to tell me which fund out of the 3 they track? You would choose, my guess is QQQY. Okay, so yeah, it's no mystery that I'm in love with QQQY. It's all I ever talk about. But he was asking which one they track. QQQY tracks the NASDAQ, JEPY tracks the S&P, and IWMY tracks the Russell 2000. But I think more than that, he wanted to know why I like QQQY the best. Well, one thing is because I'm a fan of tech stocks, and they track the NASDAQ, which is tech stocks. But I wrote a more involved answer than that. It's a little bit more complicated than that. Yes, I do like QQQY, and I especially like it for older guys like myself. QQQY has more downside hedge potential than the other stocks, more so than JP Morgan or more so than the Curve Neos ones. The JP Morgan and Curve Neos ones sell out of the money options, and not only that, they sell options in the monthly cycle. The monthly cycle is not near as efficient at bringing in premium. When you're older, generally, you might want more income, so the QQQYs bring you more income, and also because they use daily options at the same time, and it's for the same reason. The more premium they bring in, the more downside protection they have. The premium that they bring in every day serves as a buffer on the downside. Panda did an excellent video this morning. All his videos are excellent, but he showed you what would happen in a worst case scenario if we went down 25% in one day, like we did in 1987, and if the VIX went to 100 overnight or 90 overnight, what would happen? Yeah, in the first day you would get your ass kicked. You would essentially lose 25%. That because if it happens out of the blue and the volatility's not jacked yet, if it just happens out of the blue, volatility's normal, you don't pick up much buffer the first day. These things only, earn a quarter point, maybe at most a half point in a day. So you would lose pretty much the whole 25%. Say, call it 24.75%. But Panda broke out an options calculator, and he calculated what would happen the second day and the third day and the fourth day, and then you would start earning hella premiums because of the increased volatility. Whereas the guys over there at JP Morgan, they're in the monthly cycle. They don't get to reset as often as you do, so they'd be stuck with the lower amount for a longer period of time than you were. The daily reset is huge. I cannot emphasize that enough. So yes, that's why I generally prefer Defiance, and I especially prefer it depending on your situation. For old guys that want income, because maybe you're retired and you don't work anymore, so income is more of a priority than maximizing growth. For every give me, there's a got you. For every good thing about options, or about an option strategy, there's another side to it that's a hang up or a bad thing. The out of the money options are, the give me is you get more upside, but the got you is you get less premium. And because you get less premium, you also get less downside buffer. There's not one of them that's right or one of them that's wrong. They're just different. I don't know how old John is. He looks pretty young in that photo. Let's say, it's hard to tell, it's a tiny little photo, but let's say John's 35. Well, heck, you know, if John's 35, he would probably be better off with the stock like JEPQ or FEPI. That's my new favorite stock. One of my favorite subscribers turned me on to FEPI. And the way FEPI is structured has a lot of advantages, especially as far as maximizing NAV growth, maximizing total return. The QQQYs and IWMY and JEPY, they maximize downside buffer and income. So it depends on so basically it depends on your circumstances. It's like anything else. Everything depends on your circumstances, I guess. All right, let's talk profit boxes now. We've already looked at futures, but let's draw us a profit box here. Let's look at the IWMY first. These guys trade Russell options. Here's the profit boxes from the other day. There's my dog, Jackson. Jackson, why are you yawning? I think Jackson's bored. He's heard this speech a million times. He says, I know all about the downside buffer, and I'm sick of you talking about it, bud. All right. Well, let's talk real quick about IWMY. All right. So here's my spreadsheet. I'm going to pick up some new, not new subscribers, but there's probably going to be new people watching. So I'm going to explain my spreadsheet a little better today and tomorrow. All right. And the reason I'm going to pick up new people is because Retire on Dividends is not doing the updates every day anymore. So I anticipate some of the people that used to watch his updates will come watch mine. His spreadsheets are different than mine, and he emphasizes different things, but that's fine. I just need to explain mine better. So I always start from the left. You have the date, which is today's date, and then you have the contracts, the strike price, and the price the option was sold for. So the first thing where I'm different than Retire on Dividends is I consolidate the trades. There was actually two trades in the IWMY, and 1355 was not the fill. There was a higher fill and there was a lower fill. Well, I'm just trying to make the profit boxes. I'm trying to look at the overall trade, the option trade. So I picked out, or I didn't pick out, I calculated the average price. So these guys sold 528 put options at the 1355 level. Or I'm sorry, they sold the put options at the 1960 level. They got $13.55. All right. 1960 is max profit, because that's where the strike is. Whenever you sell an option, the strike price of the option that you sell is always max profit. That's a universal in options trading. So we know that we don't even have to calculate it. The max profit's 1960. The break even, however, you do have to calculate. You take away the amount of premium you sold the option for, in this case $13.55 average, minus 1960, which is max profit, and you get the break-even level, which is 1946.45. So these guys, anyone that holds an IWMY shares, what you want to see tomorrow is you want to see the Russell 2000, which is what IWMY trades, settle tomorrow afternoon somewhere between 1946.45 and 1960, preferably right at 1960, because that's max profit. If it's over 1960, that's still max profit. When it's under 1946, that's when you have a loss. Look back here on the 4th. You had an option they sold 525 options at the 1975 level for $24. So that made the break even 1950 about. Okay, well, we come over here. The market closed. Well, actually, this was a winning day, but that's fine. The market closed this day at 1957. I'm sorry, no, it's not a winning day. Well, it was a winning day. It was a partial winning day. All right, the market closed at 1957. So that 1957 is 17 points in the money. So essentially, when you sell an option, wherever it expires at the end of the day, which in this case is 1957, you have to pay that amount, however much it's in the money by. So a 1957 option is in the money by the difference between 1975 and 1957, which is 17 points. These guys sold this option for $24, had to buy it back for $17. So they did make a profit, just not a max profit. They would have weathered this on this day it closed in 1975. On a losing day, look at the next day. It's the same strike price, and they sold these for $20 on average. So $20 less 1975 is this number, 1954.68. All right. Well, where did the market close that day? I don't know. It closed at 1951.14, so it closed under 1954. Okay. So that means it is 23.86 points in the money. Now, how did we calculate that? Well, 23.86 is the difference between where it closed, and therefore where the option expired at, and the strike price. So you subtract 1950, or you subtract 1951 from 1975, and you get 23.86. So these guys sold the option for $20. They bought it back for $23.86. So that accounts for this loss over here. They showed a $185,000 loss. They were trying to make $1 million. They sold $1 million worth of premium. That's what it brought in. But by the end of the day, when they had to reverse the transaction, because when you sell something short, you always have to buy it back to figure out if you made or lost money. They sold it for $20. They bought it back for $23. The difference accounts for this loss right here. So for tomorrow, we're hoping for a close at 1960. And I'll come on during the day, and as the market's changing during the day, we'll see this number, this realized profit number will change also as the market goes up and down. Hopefully the market goes up tomorrow and this number stays on 715, 440 all day. But then at the end of the day, the spreadsheet will calculate based on where the market closes at, and it'll calculate the total profit. And of course, I'll come on at the end of the day and we'll talk about it. On an earnings per share basis, this would amount to 13 cents per share earnings if they make all the money tomorrow. If it depends on where it closes, but hopefully they'll make 13 cents a share, which also equates to 70 basis points or 0.70%. So that would be a nice winner. All right, and here's what we can also look at. What else I do on my spreadsheet is I consolidate it. In the cheerleading numbers, is earnings per share. It's earnings per share. Right now, we're minus 82 cents, which is the running total of all these other days, adding up the winning ones and the losing ones. And this 82 cents is actually assuming that we win tomorrow, but that'll change if we have a loss. But if we win tomorrow, even if we win tomorrow, we'll still be at a negative 82 cents. So it's been a really rough month so far. The month's early though, but that's the number we're keeping an eye on. As we get close to the end of the month, that number should be roughly what the dividend pays. Last month, I had the QQQYs, and they finished, let's see here. Let's actually look at something last month. Last month I had, okay, on JEPY, I had 60 cents for the earnings per share number. Well, that was pretty close to what they ended up paying. I think it was 57 cents or something. I don't know. I could go check. But the earnings per share by the end of the month is fairly close. We'll talk more about it at the end of the month. Right now, it's not fun to talk about because there are no earnings. We're negative. Like I say, the month's early. Let's talk about QQQY. All right, so these guys, for tomorrow, they sold 165 put options. The strike is 16,340, and they got a lot of money for them, $69.86 on average. All right, so that adds up to $1.1 million of premium that they received. So that's the total profit, and that number's also over here. I hid that one on the other sheet. I want to hide it on this one too. All right, so 16,340, the strike price is also the max profit. Like I say, anytime you sell an option, the strike price is where you want the market to end for that option to make a max profit. The minimum profit or break even is the strike price less the amount of premium received. So you take about $70 from 16,340 and you get this number right here, 16,270 and change. Okay, so we're looking for a close between those two numbers. And if we get it, it's $1.1 million. All right. Also, on a capture percentage basis, that is a 0.43 or 43 basis points capture if they get it. That'd be pretty nice. And it amounts to 7 cents per share if they get it. These guys so far, their cheerleading number is, hang on here, I'm going to drag this down. All right. Their cheerleading number is, they're underwater 32 cents a share right now. And that's the running total of all these days. They made 5 cents this day. They made 2 cents that day. They lost 5 cents that day. Then they lost 28 cents this day. Then they lost 15 cents. It was a rough week last week. Then they lost 5 cents. But then they made 6 cents Friday, and they're going to make 7 cents tomorrow, hopefully. But even if they do make 7 cents tomorrow, hang on, let me make sure this is accurate. Yes. Even if they do make 7 cents tomorrow, they're still underwater 32 cents for the month so far. Like I say, it's early. It's the only good thing. Okay, let's go to the profit box on this one. So QQQY trades the NDX options. So we have to draw a box where the top line's at 16,340 and the bottom line is at 16,270. All right, so I come over here and I go to 16,340 with this drawing tool. That's going to be the top of the box. Look how straight that line is. All right. Oh, shoot. Gosh darn it. You've got to be kidding me. You have got to be kidding me. Oh my gosh. I'm sorry. So the bottom of the box needs to be at 16,270. So I'm going to draw the bottom of the box. All right, I've talked about this before, but the reason I have two different colors for the boxes, they represent the amount of intrinsic premium the option's trying to capture versus the amount of extrinsic premium. Intrinsic premium is in the money amount. Right here, 16,305 is where the market closed. That's about what time they sell the options at. So the market was at 16,305 about, and they sold the 16,340. So it's in the money by that amount, and visually you can see that amount by looking at the green part of the box. The more green you see, the more intrinsic they're trying to capture. The more yellow you see, the more extrinsic they're trying to capture. Extrinsic is also called time premium. But that's the difference, that's the reason for the two colors. So there's where we're shooting for tomorrow. That's a visual representation of where we're shooting for. So let's do it on the IWMY now. We've already talked about the calculations, but we need to draw a box from 1960 all the way down to 1946. All right. IWMY trades the Russell 2000, so we're going from 1960 down to 1946. I almost hit it perfect there. All right, so that's the size of the target tomorrow. You can see the intrinsic amount represented by the green and the extrinsic amount represented by the yellow. All right, so we have one more to look at, and that's JEPY. These guys trade SPX options, so we're going to make a profit box on the chart of the SPX. We need to draw a box from 47.05, which is max profit, down to 46.89. All right. The other day's box was a little bit off center there, and now it's messed up a little bit. All right, so 47.05 is max profit. So let's see, I want to check and make sure I have this number right. Okay. All right. So there's our final profit box. That's the profit box for JEPY, which trades SPX options. So these will make more sense, or they'll be more fun to look at while the market's trading, because we can see where we are in relation to the profit box. Let's look over here at the spreadsheet for JEPY, because we haven't spoken about it yet. These guys sold 224 options at the 47.05 level, so that's their max profit. They got nearly $16, so you subtract 16 from 47.05, you get that number, so that's the break even. All right, so the total amount of premium sold is $355,000, so that's how much money they're going for. And they'll earn that money if the SPX closes at 47.05 or above. All right, so on a capture percentage, this is a 34 basis point capture, and they made 35 basis points on Friday, so it's not unreasonable that they might make that much, tomorrow. That's the good news. The bad news is you look up here at this earnings per share number, cumulative earnings per share, which is where they paid the dividend from, basically. So right now they don't have any money to pay the dividend. They're underwater 19 cents, but they aren't underwater as far as they are in the other funds. Let's look here at, running total though will be positive. The running total, it looks like, will be positive if they win tomorrow. Let's look at the fund size. Last month we had a problem with the fund growing really fast, and it made my estimate off. It wasn't the fund's problem, it was my problem, but I promised to watch the fund size and shares. So far this month, this fund hasn't grown at all. This one hasn't. Let's look at the other two. This fund has doubled in size. And this is the one I had the problems with last time, but it didn't double, it went up 7 times. But this fund right here has gone from 61 to 100. That's about an 80% increase. So it hasn't even doubled yet. I did a back test and a little study last time, and if the fund doubles or triples in size, it's no problem. That won't mess up the dividend too much. But if it goes up more than that, it will hurt the dividend. However, I don't estimate it the same way anymore. I estimate it on an earnings per share basis. The earnings per share factors in the new share count. So it's immaterial for this number. But I will keep an eye on it just because I promised I would, and I'm kind of interested in it. But I don't think we're going to grow 7 times. We would have to, we haven't quite doubled, but we would have to double another 2 times to get to the kind of dilution problem we had last time. One of my subscribers wrote a letter to Jay and asked about it, and Jay said no, it had nothing to do with dilution, and he's right, because Jay didn't see my spreadsheet. My spreadsheet was messed up because of share dilution. The fund did not earn as much because volatility went down last month, is the main reason. Okay, so let's look over here at QQQY. All right. QQQY is down 32 cents. So all of these are underwater right now for the amount of paying the dividend. 82 cents underwater, 32 cents underwater, and 19 cents underwater. All right, guys. We'll be back tomorrow in the morning about 8:15. We'll see where the futures are at that time. Let's look back at futures one more time. Well, now it's picked up. Selling's picked up a tiny bit. Futures is down 13 basis points. That's really nothing in the grand scheme of things. S&P futures down 11 basis points, and Russell futures down 9/10 of a, or 9/100 of a percentage point. So we'll see. I'll be back in the morning, and we'll see where we're at that time. And thanks for joining me tonight. You guys have a great day.